any new faces? Sorry, they've just told me that they're recording this. Thank you for joining us for this co-hosted presentation on the outlook for digital assets. The Blockchain Committee of the FinTech Association of Hong Kong is proud and happy to be doing this in association with Quinlan Associates, and we have a fantastic panel lined up this evening. You will be hearing from Ben Quinlan, CEO of Quinlan Associates, Henry Chong, CEO of Fusang, Yoon, Chairman of Eqonex, Jonathan Chong, Director of Strategy and Head of Product at HK BitX, and Angelina Kwan, Senior Advisor to the FTAHK Group. Ben, over to you.
Thank you, Kat, and thanks, Emma. Great to be partnering on this particular event. The way we're going to run this, some of you may have seen that my firm recently produced a report on the outlook for digital assets with a drill down on digital securities in particular. I'm going to spend the first 10-15 minutes of this presentation running through some of the key insights from that report. I'll run through it quite fast, so don't stress if you can't absorb all the material. We'll send you the link to the report after, and then we'll get straight into the panel discussion with all the esteemed speakers that we have here. It's wonderful to have all of the heads of businesses, CEOs, and presidents of the various crypto exchanges in the region to share their views. And then we'll open it up to Q&A at the end. So without further ado, let me just dive into the presentation so we can run through some of the elements that I want to share for today. I think one of the most important ways to start this is just to really take a step back and look at the digital asset universe and how we can look at the overall taxonomy. And I think when I sit around and hear people talking about the ecosystem, the one concern I have is so many terms are being used in the wrong way, or so many things are being thrown around with the wrong terminology, or they're being interchanged. Essentially, the whole universe as we see it, as it stands today, in our view, can be broken down in this way. Effectively, the digital asset universe, in our view, can be clustered into cryptocurrencies, which is native and fiat-based, other digital assets, which are utility tokens and non-fungible asset tokens, and then security tokens. Some of the nuances around each of these, let me just explain them to you. So the first bucket around cryptocurrencies, your native cryptocurrencies, which are both include your public native and your private native. So private native being endogenous to a particular organization, for example, and then your fiat-based cryptocurrencies, which would largely fall under the umbrellas of your central bank digital currencies, CBDCs, and your tethered stable coins. When we look at the other digital assets, a couple of ways we break that down as well. Your non-fungible asset tokens. So these can be things like your real estate tokens and your collectible tokens, and as well as what we call your utility tokens. So these can be things like your platform access tokens, a medium of exchange or buy a product or service within a particular platform, or a benefits token. So you can receive certain benefits from having that token within an ecosystem under specified conditions. NFTs, all the rage, but we kind of see this again in three core verticals: your physical collectible tokens, so ownership proof of a physical item that's recorded on a blockchain, a digital collectible token, and then a platform-dependent token. Platform-dependent is really what we call a non-standalone collectible. So the ownership proof basically, sits in parallel and whose existence is dependent on the issuing platform itself. So for example, Jack Dorsey's tweet, the Twitter NFT, it's embedded within Twitter, right? Utility token, very interesting thing you want to draw out is the fact that, we can look at an example here, Huobi, right? Huobi token is a prime example of both a platform access as well as a benefit token. It makes it quite unique and difficult to draw a parallel in the universe of digital assets. But generally, you can see here that users tend to get benefits in terms of trading fee discounts, depending on the volumes that they trade on the Huobi platform. So it's directly correlated to how much you engage with us. We'll reduce our fees accordingly. Security tokens is then the last bucket, which is where you look at on the graphic on the left from a trading infrastructure and an underlying asset perspective. Basically, anything off-chain is the world of traditional securities, and that can be a traditional or a digital asset. Security tokens are really the on-chain traditional or digital asset form of a security. If you see in the blue box on the right, number 3, they can be things like your equity securities, your debt, funds, trusts, and derivatives. And that's where we kind of break it down like here. So you can see in the security space, traditional investment security tokens, equity and debt, and alternative investment security tokens, funds and trusts, and then derivatives. All right. Just a quick case study on a recent security token, T0. It originally started as a private placement, was then shuffled over and pushed to accredited investors, and ultimately, in 2019, the token was made available to be resold to non-accredited. So that was to retail investors. What did this token provide you? Revenue sharing. So a quarterly dividend worth 10% of adjusted gross revenues of T0. One very interesting thing is when you take a step back and you have to look at why people are investing in this space. There's 2 key factors really that people need to consider when making their investments. First is financial, your return related expectations, which we understand a lot of people are focusing on. The other aspect is legal, so such as your investor rights. You can see in the cryptocurrency and other digital asset space, a lot of the legal implication aspects, your tax obligations, statutory rights, investor protections, issuer obligations, as well as whether that acts as legal tender, are either inapplicable or questionable. And that's where a lot of people are starting to ask questions. That's where regulators starting to get more involved. And in the security token aspect of it, it's basically a security, it's a financial security. So it comes with all the rights, obligations, and privileges that you would get from owning something like a share or a bond. Now, the interesting part that we wanted to focus on in our report was the regulatory developments. I think we're very aware that regulators are making moves around the world to put more scrutiny over the cryptocurrency and digital asset universe. What you can see in the graph on the left is basically our view of where the current level of regulatory scrutiny is and overall where that future outlook will go. Regardless of that particular digital asset class, we are going to start to see a lot more regulatory clampdown around this space. And that opens up a very interesting conversation as to what does this mean for future product development, for the operators in the market, and ultimately how the space will evolve, particularly when it comes to the institutional adoption story that people have been talking about for a very long time. Some of the controversies around here, for example, Ripple, right? If you look at the case going on right now between the US SEC and Ripple, it's about whether Ripple should, or XRP should be considered as a security based on the Howey test. And the Howey test in the US, is it an investment vehicle? Is there an expectation of profit? Is there a common enterprise? And does it involve the effort of others? And when you look at this, it really paints an interesting picture. I'm very keen to see what the outcome of this will be, because it will act as a very important, what I would call litmus test, an indication to how these private native cryptocurrencies may be treated in future. When you look at something like tethered stablecoin as well, a lot of people have understood tethered stablecoin is being used for transaction facilitation within the crypto ecosystem. But when you actually look at Tether's reserve breakdown, about 76% of their reserves are cash and cash equivalents and commercial paper. And of that, only 3.9% is actually cash. So there is a question, is it truly tethered? And there are moves from regulators to kind of, well, I'll explain this in a bit more detail, but to open the door to place a lot more scrutiny on these tethered stablecoins, particularly as they act as a potential challenger to fiat, and particularly with the growth of CBDCs running in the background as well. We all know the developments in Hong Kong around the new licensing regime, Type 1, Type 7 licenses being required for virtual asset service providers, and the retail window being shut off. So all of this now being focused on high net worth professional investors. We at the FinTech Association of Hong Kong, Emma, Kat, a lot of people were involved. Henry, I believe, is on this call. in providing our views on, we would say, the short-termism around that. We would hopefully like to see the retail market open up, but let's see where that goes. The other side is, even if you look at the US SEC, they have announced the creation of a very comprehensive legal and regulatory framework across different types of digital assets. Some of the things is around the powers of intervention, digital assets needing to be registered, CBDCs and stable coins explicitly not being the same thing, and a proper licensing regime in the pipeline that is soon to come. So definitely watch this space in terms of the SEC's moves. And then I think the final thing is, all regulators across the world, well, many of them have started to converge on the fact that a security token falls under the definition of a regulated security. So the legal position right now is that security tokens will be regulated by general securities regulation within the market. So that's the starting basis of how this asset class is regulated. And what's important, just from my perspective, is that the regulators don't get confused with what they are regulating. I'm happy to see them regulating the asset and the security. I just want them to avoid regulating the technology, which is something they should generally stay away from. So security tokens. As you can see, this is that laundry list of the asset classes. What's the regulatory outlook and what is the adoption outlook? We have a very bullish view on the security token outlook. The reason why, it's been around a while, but it hasn't taken off. There's so much chat around institutional involvement, but it hasn't really come. And the question is why? It's come in the form of hedge funds. It's come in the form of some family office money, but true long-only institutional asset managers have been very slow, if even able to enter into this ecosystem. Fiduciary responsibilities, other things around their investment remits, needing to create a product that you can put in front of them that they would say, now I can invest. The irony, even when you look at Coinbase's listing, Goldman Sachs, Morgan Stanley bought into that because they could. It was a NASDAQ listed share, but they couldn't actually invest in the underlying directly themselves, although they do it prop for some of their clients. So a very bullish outlook. Other things around CBDCs, very bullish outlook. And of course, the NFT world, we all know what's happening there. Very bullish outlook. Why is this important? Transparency, streamlined reporting. This is a very important part of being able to make the compliance process through a centralized blockchain much more efficient, as opposed to going through multiple intermediaries with fragmented records. It can really help with this part of the process. If you look at programmability aspect, security token trading lifecycle, what you can see, and Kat, I know you've had experience in this from your days at Hong Kong Stock Exchange, but the typical T+2 cycle, and in Kat's case, she was mentioning it could be as long as T+8. Is that right, Kat, in the case of Hong Kong?
Yes, it can be as long as T+8, and it's even gone as long as T+14.
Oh man, that does not sound fun. But the idea is, on the clearing and settlement side, when you can automatically program this into a smart contract, you can effectively reduce the clearing and settlement process to instantaneous. So it does then open the discussion around what does this mean for intermediaries, particularly securities depositories, clearinghouses, and transfer agencies. Divisibility, or fractionalization, as many people talk about, that allows for much lower levels of liquidity, or lower levels of price point, to get into the market to drive even more liquidity associated with this asset class. Let's take Berkshire Hathaway, a $500,000 share. Why don't you buy one way of a Berkshire Hathaway share, which will cost you I don't know how many zeros are in there, but not much money. So fractional share trading being something that the digital asset universe opens up, particularly on the security token side as well. The broader thing that people don't realize is many stock exchanges around the world are also dematerializing. So they're moving from paper-based script to digital. So for example, SEBI in India has said no transactional transfer of securities of a listed company can occur in physical certificate form. So it's rendered all physical securities effectively illiquid. You are seeing this convergence happen across the world. Timelines ranging between 22, 23 up to 2025 for different exchanges. But this is going to be a very important catalyst for the growth of the digital security ecosystem. And when you look across the life cycle, from drafting a contract, monitoring conditions, security transaction itself, and clearing and settlement, the traditional securities process is very manual, cumbersome. It's not programmable. In the security token space, it is, and people are starting to realize this. I'm having a lot of conversations with the banks, the funds. They all start to understand there is something here, and there is a huge amount of efficiency that can be gained from moving to this model. So a very bullish outlook, as we can see from the graph on the left in terms of issuance volume. Right now, it's basically nothing. It's very, very small. But when we've seen the DBS UOB adoption, we're seeing ASX probably moving its back end on blockchain by 2023. It has been delayed. But when major dematerialization occurs in our view 25, 26, that's when you're going to see this go nuts. And I think the mass market adoption story by the end of the decade is something that's very feasible, with probably over a quarter of the issuance taking place as blockchain native securities. Trading volume wise, because now you have 24/7 access to liquidity with many of these exchanges, which you don't with traditionals, that will bode even better when it comes to the trading story. So we expect over 40% of the market to be trading digital securities by 2030 as well. Very quickly, just converging onto the back end of this presentation, the exchanges get it. And this is what you're going to start to hear from today of all the major exchanges. Traditional are moving their back ends. Digital asset broker dealers are utilizing different licenses like ATS licenses to move in this space. And the cryptocurrency exchanges are starting to recognize we might need to be regulated. Binance has gone so far as, they launched a few products, they got in trouble. Overall, the CEO has come out saying, we understand we have to play a regulated game. So that regulatory arbitrage window is narrowing. I won't go through this, but these are just some examples of the traditional exchanges, again, from the clearing and settlement side, moving on to blockchain. The incumbent cryptocurrency exchanges starting to understand the need to play the licensed game and not play as much regulatory arbitrage. And then the digital asset broker dealers as well, leveraging these alternative trading licenses to start to offer the ability to issue these kinds of products to market. But no one's quite there yet. And this is what we want to unpack and explore in this session. Final thing, and I'll wrap up here, the winners and losers. In our view, from an issuer perspective, faster issuance, wider investor base, and optimized compliance and reporting. Makes a lot of sense. It's speed to go to market and ability to tap into a wider pool of investors. From the investor side, more products. Everyone's interested in new asset classes. The instant settlement time de-risking, as well as the 24/7 access to trading. When you look at that 24/7 access, let's put it in perspective. Let's look at a traditional exchange, compare it to digital asset broker dealers and crypto exchanges. Just from a time perspective, 5.24x in terms of blended average hours and the ability to trade on that platform, right? From an issuer perspective, we can probably see at least 18, 20% off costs long-term. I think a lot of the disruptor exchanges that will be facilitating this will be making this 80, 90% cheaper than doing a traditional IPO right now. But in the long term, I think because of the efficiencies you can gain from this, you will start to see issuance costs come down for a lot of these kinds of products. From a trading fee perspective as well, anyone that has a private bank on this call, I know there are zero fee and zero commission trading models, but it's still, if you go with your bank these days, anywhere from 25, 30 bips, 40 bips, 50 bips with your traditional broker, try the 6 to 20 bip maker taker spread that we're seeing in the market as the reduction in cost. And that brings us to, how is this all going to stack up for market participants? Let me put this final visual in one graphic here. From a primary and secondary market perspective, you can see our view on the revenue impact. So the token generators, technology auditors, the security token exchanges, the custodians, all very positive. Financial auditors, law firms, sponsors, underwriters, yes, they will benefit, but it's just going to be a shift of business from, traditional to digital. So it's flat in our view. But brokers, settlement bodies, transfer agencies, big potential here to be completely disintermediated. And that's going to be an interesting space. But as you can see here, securities token exchanges, Big revenue impact lies ahead, and that level of impact is going to be the highest. And we expect them to be the major beneficiaries of this move to digital securities. And I'll stop on that. All right, well, there was a lot that we covered in that, and really it's not about what I have to say, it's about what the speakers and panelists have to say today. And I'm really looking forward to hearing from them and getting their perspectives on some of the topics that we covered in this initial presentation. So the first question I want to pose to everyone is, what's your take on the recent regulatory developments in the digital asset space? I was talking about the reg arbitrage window. Do you see it widening, narrowing? What types of digital assets? How do you see this panning out? And maybe we can start with Angelina. Would you like to share some views?
Sure. Thank you, Ben. And it was a really great presentation. And I love the fact that I think all of us are bullish, and I think the whole panel will be quite bullish on this. And I personally am. So I work for the FTAHK group, which is hopefully the next exchange that will receive the virtual asset service provider license in Hong Kong. And we will be offering almost every single thing that Ben has discussed tonight. One of the good things is, as you are aware, the regulatory net is coming in, more and more regulations are coming in. And what does that mean to all of us? It means that, number one, virtual assets are here to stay. Number two, the outliers that do not get regulated will probably get in a lot of trouble. And then the third thing is, for those that are either in the process of getting regulated or thinking about getting regulated, this actually makes our business even better. And I think it's just a growing part of the pie. For Hong Kong in particular, for those of you who know our deputy CEO of the SFC, Julia Leung, she came out with a speech at FinTech Week on November 3rd. And one of the issues has been the ban on retail to trade. I think in Hong Kong, I think the SFC and the government are starting to look at that again, and discussions will begin in terms of looking at this area. So all is not lost, and I'm positive that the government will work together with virtual asset service providers to hopefully release that regulatory issue to allow retail to eventually trade in Hong Kong. Because currently, for licensed people like the virtual asset service providers that will be licensed, we cannot deal with retail. We can only deal with professional investors. And then the last thing I just wanted to say for this question is, for those of you who know about the public consultation paper, where the 30 exchanges in Hong Kong that will then also be subject to regulation, that is expected to come out, but in about a year and a half. So I think we do have time to work with the government, and every voice is really, really important. And FinTech Association is so important as a voice, as is Bitcoin Association. So please, please, please come out, work with us to work with the government to come up with a good regulatory regime so that Singapore doesn't Singapore doesn't win over us, and we keep financial services and virtual assets here in Hong Kong.
Thanks, Angela. Very, very useful insights. Henry, why don't we shift over to Labuan? You were the first digital securities exchange in the region. What are your perspectives on this?
Absolutely. Good evening, everybody. My name is Henry Chong, and I run Fusang. And Fusang's vision really is to make it as easy for people to be able to invest into companies as it is to buy their products online through e-commerce. And to me, I think that's really why all of us on the panel are here today. Everything in the world is becoming digitized. Mark Zuckerberg is going to have us living in his metaverse in a couple of years' time. You know, we buy everything on Amazon. We talk virtually like this. We are kind of in the metaverse already. But as Ben pointed out, when it comes to the back-end settlement process of securities, the 99% of world assets that you see around you, the buildings we live in, the companies we work for, these are almost always represented by a slip of paper somewhere. And certainly in Hong Kong, that's a physical piece of paper for company shares. So I think this move towards tokenizing everything, including securities, is inevitable. And I couldn't agree more with Angelina that, like it or not, once you touch securities, you need to play by certain ground rules. I think sometimes people who come from the crypto space hope that they can bring new tech and that the rules will change to suit them, and that's never the way it works. Unfortunately, regulators are always a lagging indicator, and they like to fit new technology into existing boxes. And at least for Fusang, that's been our philosophy, to say, how can we tokenize assets, shares, bonds, funds, etc., but do so within existing regulatory frameworks? And we're very grateful that Labuan, and actually Malaysia more generally, has been really a pioneer in the space. Malaysia as a country early on decided to both recognize digital assets and, for better or for worse, decide that all digital assets, things like Bitcoin included, should come under existing securities laws, and more specifically that they wanted to license people in the digital asset space using an existing licensing framework instead of having kind of parallel traditional and digital licenses, and that both players should be subject to the same rules and regulations. I don't want to get too much into talking about different jurisdictions because we actually operate in many different places. But as a principle, whether, if you're a regulator listening in or whether you're an intermediary, to me, it is very important to separate between what I call the technology layer and the asset layer. And I understand that because you have assets like Bitcoin that are digital native, it's quite hard to disentangle the two. And so a lot of people treat them as the same. But when it comes to securities, it's very important to separate the two. And I think that regulators shouldn't get caught up in the technology layer, which I understand can be novel, a bit freaky if you don't quite understand the technology, and look instead at the underlying assets and say, what are these things? If they're shares, how can we fit this into our existing framework? If they are NFTs, and I don't like that term because, again, I think you should look at the underlying asset. These are art tokens. Again, what does that mean? How do the frameworks work? And I think if you start from that perspective by saying, what is the asset and what is the activity, then things can become a lot clearer. And I would say that there are plenty of countries and jurisdictions around the world that are adopting that approach. And I would encourage other countries, Hong Kong included, to follow suit.
Thanks, Henry. Very good points. Very good. What do you think, Yoon? Anything to add on that?
There we go.
There we
Hi,
go.
Ben. Hello, everyone. My name is Chi-Wan. I'm chairman of Eqonex. We were formerly known as Diginex. We are a NASDAQ-listed crypto exchange. Bulk of our people are based in Hong Kong. The exchange is based in Singapore, and we have a custodian that is FCA licensed based out of the UK. So as Henry mentioned, we touch many different jurisdictions, but what we're trying to do is to operate on a fully regulated platform across all these jurisdictions. So I would very much agree and echo the sentiments expressed by previous panelists. We have been and we are very vocal proponents of ongoing regulation, and we actively support efforts by regulators to provide more clarity, which will be, I think, still very helpful and is still very much needed in our space. And for exchanges like us that are committed to operating in a regulated way, the lack of regulatory consistency and clarity has really impacted our growth trajectory relative to other market participants that have ignored those barriers. However, we believe that institutions are gravitating to operators like us that are focused on compliance and regulation.
Wonderful.
Now, yeah, if I can just sort of talk about challenges for the regulatory environment, I think Henry's touched upon this a little bit. It's been difficult for existing regulatory bodies to shift their approaches to new world digital assets and crypto because, as Henry mentioned, they operate under long-standing definitions of things like securities, commodities, real estate, etc. And digital assets do not fall naturally under any of these definitions. So when we look at Hong Kong specifically, we have 4 regulators with defined roles in the financial system. But this means that crypto can slip between the cracks or sit across more than one body, right? So for example, certain aspects could fall under the SFC and another could fall under the HKMA's authority, right? So I think greater clarity would be very helpful in regulating this space. And that story is also quite similar in other jurisdictions. I think Ben mentioned early on that the US is now just getting around to coming out with some digital regulations or digital securities. But up until very recently, the SEC typically viewed cryptocurrency as a security. CFTC claimed that it was a commodity, and the Treasury called it a currency, right? So I think, this whole harmonization of how regulators view this is actually quite important. And I think the journey has begun. The last point I would make is that when it comes to regulations, I think the main players are now fully aware that regulatory oversight has now become inevitable across most jurisdictions. So market players are actually becoming much more proactive in obtaining licenses across the board.
Great, thanks, Yoon. Very good points, particularly around the lack of what I would call harmonization between the way that the universe is evolving from different regulatory and governmental standpoints. Let's bring it all the way back to home in Hong Kong to Jonathan with Hong Kong BitX. What do you think, Jonathan?
Thanks, Ben. Hi, everyone. I'm Jonathan. I'm the strategy director and head of product here at Hong Kong BitX. So like HashKey, we are also, fingers crossed, hopefully getting our license too in Hong Kong from the SFC. We are an infrastructure player where we also have a tech arm that focuses on STOs and security tokens. We've been pretty outspoken on that since the very early days. We also have a custodian and we have insurance partners for that. But back to the question that Ben posed, I think I agree with everyone's comments earlier. I think we're pretty much in agreement. Just a little thing to add is that I think it's increasingly evident that countries are all moving towards more regulation, be it crypto, security tokens, payment tokens, whatever the classification, it's a global trend. And I guess the regulation will narrow over time. That's how I see it. If imagine we fast forward 2 years or 3 years or however long it takes, countries would converge in their views. I would see that eventually countries would mutually recognize each other, whether it's AML or KYC or the classification of digital assets. We would come to a place where we get agreement, we get a consensus, and then we can adopt best practices globally. I mean, US, Europe, Singapore, Hong Kong, Japan, just think about the major financial centers of the world. If these countries, we reach some kind of agreement, we pretty much set the standard for the rest of the world. So that's really just how I see it. Just to add a little bit to everybody else's comment, I'll keep that short.
No, I mean, Jonathan, maybe you can lead off with the next question, because we're obviously talking about the regulatory environment. I mentioned what's going on with the SFC. There are new restrictions around licenses, the PI focus, we barred mass retail market participation. Because of all this, what do you see as the future for digital assets in Hong Kong? And is this likely to be a negative for Hong Kong, or does it actually set it up to be more of an institutional focused digital asset hub?
I think in the short term, it's definitely going to be institutional focused, at least for Hong Kong. The SFC has been very clear on that with the position paper and in FinTech week and different public places. So I'm pretty sure in the short term, it will be institutional focus, which also matches the character of Hong Kong, right? Where we are a major financial hub. There's a lot of old money here. There's a lot of family offices. Just being prudent is the way to go. I wouldn't dismiss that. Although we might view this as a little bit of a restriction where the mass public cannot engage, officially in cryptos or digital assets, but I remain optimistic that eventually we'll get there. Some EU countries, the United States and Singapore, they're already retail friendly. So I think SFC being in the position that they're in, staying prudent is in the best interest of everyone here in Hong Kong, the mass public. But we'll definitely get there is where I think we'll see, and it's a global trend again. It's like a massive force that you can't hold back.
Yeah.
But we just have to make sure we get there, and we don't rush into things, but to get there correctly rather than rush into it without considering a lot of the other factors that may come because of that.
Angelina, just what do you have to add to that? What's your view on the outlook for Hong Kong specifically, given the regulatory environment?
As I agree with Jonathan, but I think as Julia has said, who is the deputy CEO, she noted in her speech that Hong Kong is undergoing a metamorphosis, and hopefully this metamorphosis turns into a good butterfly out of the whole process. So I think the government and the SFC are working together. As I said earlier, there's a working group that started within the government to start looking at virtual assets. It is partially because also there are some high-profile people or companies that are leaving Hong Kong, which is not good for Hong Kong as a financial center, and most importantly for jobs. As well as experienced personnel. We need these people that actually work in digital asset firms, blockchain firms, because they also provide the backbone of the people that will be working on the bigger governmental projects like CBDC. So it's important that we have a good group of technical as well as financial services persons that can build Hong Kong as a digital asset and financial services center for Asia. So I think the move may move faster than we initially thought, from just professional investors to possibly start looking at possible retail. And I'm just looking into some of the moves that are happening and discussions that are happening. I don't have those yet, but we will soon find out what will be happening. And I'm sure the government will make some announcements because of some of the people leaving. So I'm positive in that respect that the government will do the right thing. And I'm positive also that I think this is the only product that retail has not been able to trade in. So retail is able to trade in securities as well as futures and other products as funds. And with the advent of the exchange traded fund in the United States, with the first approvals, I'm sure this is an area where HKEX would be also most interested to offer also. So I think it would be important for Hong Kong as a financial center to be able to have these products. One thing I wanted to also mention is Hong Kong is moving. Your paper is very relevant, Ben, because the consultation conclusions came out about the scriptless proposals. And it was unanimously approved between HKEX, SFC, Federation of Share Registrars, that Hong Kong is going to move towards a scriptless market. And this culminates work that I did for 8 years when I was at the SFC, and another 10 years from my colleagues in the markets division in the SFC. So everything that you're saying in your paper is also coming to fruition, because we will be moving to a scriptless market. It's the question is how long and how, which would coincide with what we've all been saying, all the panelists have been saying. So I think that will be a good thing.
Great. Good. No, very, very. Yeah, look, I think the move to scriptless, the dematerialization impact can't be underestimated in terms of what this means for the future of the digital asset ecosystem.
And for those of you who don't know where it is, it's in the SFC consultation conclusions. It came out in 2021. So you could read about the blueprint for dematerialized securities.
Great. Okay, so we've heard from the two local players. Let's add the Malaysia and Singapore lenses into the Hong Kong story. What do you think, Henry, for Hong Kong?
I think that, again, not to get too much into jurisdictional differences, but like it or not, digital assets are a global market. And people here in Hong Kong can and are transacting in cryptocurrencies directly and will continue to do so, right? Whether you like it or not. And if they cannot transact with a Hong Kong platform, they will transact with people elsewhere. And if they can't transact with a licensed platform, they will happily transact in highly unlicensed speculative venues. Some of you might have seen the news recently about a guy who tried to do an in-person OTC deal around Bitcoin and ended up getting kidnapped. These things can and will happen. And I think that if you actually care about investor protection, the right approach is to bring things within the regulatory net rather than trying to exclude it. But I think most pertinently, as Angelina was mentioning, as more and more ETFs get approved on stock exchanges around the world, it is going to be exceptionally difficult for regulators to prevent people from trading them like people can trade any listed stock on any other exchange. And people are already beginning to trade some of these ETFs listed in Hong Kong. Again, if I'm a Hong Kong broker, very hard to start picking out stocks and say, oh, you can't trade that one, but you can trade Apple shares, for example. More specifically, as I said just now, I think regulators need to really begin to distinguish technology and assets. I think one of the issues in Hong Kong is that there are not clear definitions around what exactly a digital security is. I assume the regulators have something in mind, but I think that if you start to dig into some of those classifications that you highlighted in the paper, it's not so easy to draw the line between what is a dematerialized security, for example, and what is a blockchain-based security token. More and more exchanges, including ASX, are looking at moving certainly back-end settlement systems on the blockchain. Where's the line, right? Where's the point at which suddenly something is digital enough that suddenly retail investors can't trade it? And honestly, as I think some of the other panel speakers have said, these distinctions really just don't make sense anymore. And I think that all regulators need to go back to saying, what's the asset? Can I fit this into my existing regulatory processes? And certainly my own personal view is that you should not have separate processes for digital or traditional, that you should just figure out what are my principles around the asset and apply these universally across digital, non-digital, scriptless, etc.
Great. Ji-Won, what do you think?
I think a lot of the speakers have actually touched upon most of the relevant topics. One thing I would just add as a potential additional headwind for Hong Kong at the moment is the rather aggressive nature through which the Chinese government banned crypto and this mining activities and trading of crypto assets. And I think there's a lot of concern within the community that Hong Kong will follow suit. And, I think that's something that the government should address sooner than later. I mean, my interactions with regulatory bodies, all the suggestions are that they are taking a cautious but generally supportive approach towards crypto activities. So we keep our fingers crossed, and I'm encouraged by Angelina's comments about revisiting the retail ban and taking a look at that. I think that would be very welcome because, as we all know, the pro-tail and retail investors still make up the largest revenue market segment in the crypto exchange space, in the space in general, right? So while the institutions are coming in, still the bulk of the P&L opportunity lies with retail or pro-tail clients. So that's an important point. The last point I would make is if Hong Kong is actually positioning itself as an institutional focused digital asset hub, then I think they really should take a progressive stance on allowing trading of crypto derivatives to attract institutional participants, because I think that's, if you take that away from institutions, I think that's actually taking a very important toolkit away from institutional players.
Completely agree. And that's coming from your experience heading up derivatives in your career and then markets. So you understand what the institutions want to bite on, what kind of products they need to drive liquidity in the market. So, and I couldn't agree more on the China part, just given Hong Kong is evolving where it seems to be running as parallel narrative with International Financial Center and GBA. And I don't necessarily think those two narratives coexist that cleanly. So we'll see how it pans out. So that brings us on to the idea of, you know, all this regulatory scrutiny. Our view is security tokens are then emerging as what we see as a more institutional friendly digital asset. What's your long-term outlook on security tokens and the benefits that it can provide market participants? Do you share the same sentiment, or do you have another view as opposed to us? Henry, why don't I start with you on this?
Absolutely. I think it's absolutely inevitable. And to me, again, tokenization is a tech layer. The question is, what are the underlying assets? And if you think about shares, bonds, funds, I think Kat was mentioning, you have sometimes incredibly long settlement cycles. It just makes eminent sense to move onto a blockchain-based system. I actually think that dematerialization is a positive step, but really only a half step. Plenty of other jurisdictions have dematerialization in the sense that I do not have to have physical paper, but that means that I now have a PDF of a share certificate. It's not really machine interactable or intelligent. And when you look at one of the first ever, or the first IPO, if you will, of the Dutch East India Company 400 years ago, and you look at a share cert in most jurisdictions today, they look kind of the same, except one was written on parchment and one's a PDF. And being able to tokenize an asset and move it around. And again, I think that today, when you can see the interest around crypto and NFTs, you don't really need to oversell that benefit anymore. I think that what the industry, or the security token industry, needs now are clear use cases in the sense of issuers coming along and being able to bring high quality assets to the market. And yes, as you said, the institutional money also coming in to play in the space. There have been a large number of banks and traditional financial institutions starting to do security token issuances in some way, but most of these are still a POC or some form of really internal test. You'll have one issuer, one buyer. Nobody has really been able to push out to market and say, hey, why can't we just take a traditional stock, and instead of IPOing it and listing it on the Hong Kong exchange, why can't we do this with a token instead of paper share certificates? And I think that as all of the panel speakers here today, and as our firms bring these assets onto the market, the technology layer will start to dissolve. And people say, oh, okay, hey, I can buy this stock here, I can buy this stock here. And then the question becomes, which asset do I want to buy? And to me, the analogy I would give in terms of how you would think of this market evolving is just like when we had the shift from open outcry pit trading. When I was a kid, trading was done with hand signals on the pits of exchange floors, to today where it's all electronic. The same thing is going to happen to the underlying settlement layer, where it's all turned into tokens, but with a new technology layer, you're still trading the same underlying assets.
Great. Henry started trading when he was 3, ladies and gentlemen. So this is his first language. Jonathan, what do you have to add to that? Securities, digital securities, what do you think?
So I think security tokens and digital securities, the outlook is very positive. We're very bullish on that because unlike other digital asset types, its propositions are very clear. You know, it's defined as a security. There's nothing to, no doubt about that. It's asset backed, and a ST issuance, you require a whole team to come together to have this deal done, right? So you have law firms, you have auditors, you have brokers and financial advisors. It's almost like an IPO, but like a mini version. And because of that, it's very transparent, it's very legitimate. I mean, it adds a lot of confidence for all those non-believers out there. This is the perfect bridge for traditional players or the non-believers to, try this out, right? Bridge over. This is it's a very fitting product and use case for it. I mean, and it's not just a new fundraising channel. I mean, security tokens are a new financial product altogether. For the issuers, you can be very creative. It's really up to you, right? You can back it with rare commodities, you can back it with equities, or you can, do structured products. It's really up to your imagination. And for investors, it's like oh my God, it's awesome, right? Because you can get in and out of positions so easily. Imagine in the olden days, if you got into private equity, you're locked away, right? If I invested into a fund with a LP interest, I'm locked for years, right? But with security tokens, not only am I there's liquidity there, I can get in and out. There's fractionalization. I don't even have to commit that much. Maybe a lot of investors can just try it out and test the waters. Yeah, I think this is a great use case for not just for the world, but for traditional finance, for capital markets to make that paradigm shift.
Chi-Won, how's your view on digital securities? How are they going to fare in the digital asset world?
Oh gosh, as you mentioned earlier, I was a banker, traditional banker for 35 years before I retired, right? So I think there are certain things which I'm really excited about. I mean, firstly, if you talk about the stock market that has sort of like a 6-7 hour trading window, these securities trade 24/7, settlement of T0. I mean, that is just, to me, that in and of itself is an amazing benefit, right? But I just want to zoom out a little bit and take a look at everything in a slightly larger scale, because I know other panelists can talk specifically about examples. There's about $4 trillion locked in private equity and many more trillions in real estate. And of course, now tokenizations open up assets to global investors and provide way to trade previously illiquid assets that typically would trade at 20 to 30% discount, right, relative to public securities. So that in and of itself is a massive benefit. I do see a lot of potential in reducing costs. Bond issuance can go down by cost of doing that, could go down by 90%. Cost of reducing or cost of compliance will go down dramatically. Financial industry spends about $180 billion a year on compliance costs alone. And I think having all these blockchains rules programmed directly into security tokens will reduce error and also make it a lot cheaper to manage complex compliance requirements. And I think, to me, as a former banker, I can tell you that outdated financial infrastructure and manual processing requirements really limit the type, the scale, and availability of product and service offerings. And these programmable contracts will eventually open up doors to liquid revenue sharing agreements, dynamic ETFs, and other previously unmanageable offerings. So I really look forward to having a front row seat and watch how the blockchain-enabled security tokens will impact traditional finance in the years to come.
Wonderful. Angelina, it looks like you were itching when Chi-Won said infrastructure, and please do share.
And Chi-Won is spot on in terms of it. And what Henry was also saying and Jonathan was saying are all spot on. You have a shift from the ICOs of the early days that really gave a very bad taste for people. But now you're moving into the next level of smart contracts that are really getting smarter and smarter and smarter. You can get dividend payments and so on and so forth. And then what you're seeing is the firms that are here today and the firms that are around the world, you're seeing what I see as racetracks. So we're all getting licensed as these racetracks, but we don't have enough gas stations. We don't have enough participants in the racetracks. We don't have enough participants that are ready to be able to plug into the racetrack. And I think this is what Chi-Won started talking about, because the institutional investors and the retail we're the first few firms here that are getting licensed in Hong Kong. But what also has to come up is people need to get wallets. People need to understand. There needs to be investor education. There needs to be more, not just investor education, but market participant education. We have 700 exchange participants on HKEX. And they're still working on the previous iterations of AMS and the next systems, but can they connect into the next iterations of smart contracts? No, not yet. And all of that needs to be sort of thought about in terms of a whole infrastructure plan to bring Hong Kong up to the next level of digital assets and the next iteration of the future. And I think we need to work with our government, and your paper will be very important. We need to work with our government to have a blueprint of how do we get people to the next level, and how do we teach them how to, and is it a part of the government that does this? When I was at the SFC, we had Andrew Sheng, and we started what was the structural infrastructure projects, what we called SCEFI, which had nets between the regulators and working together, and participants could file their financial returns to the SFC. Well, we need to move that infrastructure to the next level where Hong Kong becomes a payment system. And no other countries have really started a wholesale blueprint plan to do that. And I think if we want to achieve full immutability and using the blockchain, I think all of us need to be connected together and be connected with the other 700 brokers plus thousands of regulated persons in Hong Kong, as well as the investing public. And that's something overall, as FinTech Association, a blueprint might be thought about, and we can work together to do that.
Wonderful. Yeah, I mean, it's interesting because we run through all the benefits. I think everyone here is bullish. Everyone understands. Everyone knows. Cheaper, faster, better compliance. Boom, 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 boom. But so many institutions are still sitting on the sidelines, right? Yep. So what's it going to take? What is it going to take for true institutional adoption to take place? What is holding it back? Jonathan, why don't you share your views on this?
Sure, I guess quick, easy answer to that is quality projects.
Right.
Number one, right? I mean, to get adoption, number one is what am I buying, right? I mean, whether it's in the form of a security token or not, don't matter to a lot of investors, right? It's only just, okay, if I have a quality project, I get a good ROI on this, I'm gonna go into it, even if it means being adventurous. And that's what we need right now, adventurous issuers, adventurous investors. Yes, the hurdle to getting a wallet, the hurdle to understanding security tokens, its risk, and also its benefits. There's a huge educational hurdle that goes into this. And it's not just the issuers and investors, but all the other market participants to make this deal work. So do the lawyers at a law firm understand blockchain? Can they write up a OM for this? Would the auditors know how to book this? What's the accounting treatment? Like, there are a lot of questions that which we need to figure out. There's regulatory clarity, there's clear tax and accounting treatments, which varies by jurisdiction. So these hurdles we need to jump through. But and these are things that are preventing things from happening at the moment. Yeah. But again, if you have a quality project and a good enough use case, I believe once the first successful case comes out and people can see that, whoa, this thing actually works, and there are quality projects in here, and there is good liquidity, and there is T+0 settlement. Whoa, I get paid dividends right away. It gets airdropped, things like that. Then they realize, oh my God, this is like revolutionary. Right now, all of us are bullish, but for a lot of the traditional players out there, they are still wrapping their heads around this. And until they see something happen, it's all just talk, right? It's all in the clouds. So I guess that's really where we are now.
Yeah, I mean, my view is crypto went through a branding and PR crisis over the years, right? From an institution perspective. And then you can say, here's a digital security, and they'll be like, oh, cryptocurrency. And you go, no, you know, you need to listen to what we're talking about. I believe the education gap is a major issue. Henry, what do you think?
I completely agree in terms of the points around quality products and infrastructure, education, as you mentioned. But maybe actually to offer a slightly different perspective, I think that maybe two big barriers to a lot of institutions really engaging. You know, you think of big bulge bracket Wall Street investment banks. The first is that big institutions can be very siloed. I remember talking to the ECM head of a major bulge bracket bank who said, I love crypto. I mine it. I mine Bitcoin in my bedroom. My single biggest investment is Bitcoin. But as head of ECM, I don't care. I'm just going to do the biggest IPOs that make me the biggest fees. I have no incentive to try and build up some new market. So I think that's one big barrier. But I think the other big barrier is a lot of institutions are actually very worried about whether they'll really be able to leapfrog onto this new technology wave. And I talked earlier about how, hey, this is the same assets, just a new technology layer. In theory, incumbent institutions should always be the ones who are best positioned to take advantage. They've got the resources, they've got the connectivity, but somehow when you look at these technological shifts, including in financial services, that isn't always the case. You know, when you look at who the biggest stockbrokers in the world were in the 90s, nobody's even heard of these names anymore, except, well, Lehman, and that's gone as well. Somehow when technology shifts, often the players tend to shift as well. Prime example, I was talking earlier about the shift from, you know, open outcry trading to electronic trading is a firm like Citadel Securities. They do what, 20% of US equities volume on any given day. Again, I remember when I was a kid and 3 years old starting to trade, Citadel was a hedge fund. They ran one macro fund and that was it. They had no business being the biggest market maker in America, but they were the ones who just leapfrogged onto electronic trading way quicker and way more aggressively than anyone else. So I actually suspect that as this big wave of STOs really comes about, there are going to be a whole new crop of players. You know, you've got banks like Galaxy Digital in America, very quietly are worth what, $15 billion today? Credit Suisse is 25 billion market cap. So I actually suspect that a lot of people don't realize how quickly some of these new players are emerging. And actually, if you were a betting person, you'd say that these are the firms who will really take advantage of this new wave. And quite frankly, I think all of us on this panel today, because we hope our firms will be part of that ecosystem. I think that what it will take for this industry to really take off is as new projects come and as new players enter the market, people need to start seeing the success of the whole ecosystem of players, not just platforms, exchanges in the middle, but people who act as listing sponsors and brokers and all the rest of it. And when people see the opportunity, that's really when things shift. Let's face it, we're in finance, people like incentives. People don't move just because you tell them, hey, look, a big tech wave is coming. People will move when they see real life projects brought to market and they see a financial opportunity and wallet share, right? That's what really drives activity.
Thanks, Henry. Chi-Won, you started trading when you were 4, not 3, but you ended up having a very successful career in banking. Chi-Won was my old boss. He was the regional CEO and chairman of UBS. But on the market side, you obviously mentioned the point around derivatives being very important. What else do you see as missing? You were in that seat before. What would have made you pull the trigger to move down this space?
Sure. I think, you know, if you really step back and take a look, the core infrastructure to do IPOs, traditional IPOs, that practice has been around for hundreds of years, right? So I think the biggest obstacle for quick adoption is a lot of these institutions' internal infrastructure is still not where it needs to be able to accommodate the requirements of blockchain-based securities. Right? So whether it's booking, operations, custody, risk management, all these things are not really fit for purpose for digital assets. So I think there will have to be a period of, shall we say, renovation of the infrastructure for these traditional institutions to be able to take advantage of these new securities. So I go back to some of the points that other panelists mentioned. I think there's a huge education gap. So we need to spend a lot of time educating everyone, both in institutions, back office, front office, regulators. And I think also that, you have to sort of take a look at things like custodians, right? I mean, many of the custodians are not ready to custodize digital assets. And yet, if you think about it, most institutions will expect similar features to what they get in traditional finance from these securities, right? So the entire ecosystem has to go through a process whereby they are modernizing their infrastructure to be able to cope with these new asset classes.
Right.
So I think that's really the key point.
So we've spoken about products, engagement of third-party advisors, infrastructure. I think these are all fantastic points. Angelina, how do you want to round this off? What's it going to take for the institutions to pile in?
I think it's going to have to be the regulators and the government to allow and to recognize that this is here to stay. And what Chiwon and what all of our panelists are saying is spot on in terms of, if the government says, hey, this is a real asset, HKEX, please tool up your systems to be able to accept tokens, or hey, Northern Trust, you need to add in custody for all of your institutional players. And it starts with that it's okay to do this. And this is not something in the back alleys. That's Bitcoin is here to stay. Tokens are here to stay. And you can do this. Then you're going to get movement. Now, will all of our local brokers, our 602 local brokers, do this right away? Probably not, because there are family owned and one-man bands, and maybe they'll decide to stay in their securities world. But I think from 1 to 100, which are the exchange participants on HKEX, those definitely, and maybe 1 to 200 of the top securities futures brokers in Hong Kong will want to do this. But they have to be given a route, and they also have to be given an okay. And I think that starts with the adoption, and the guardrails need to come out to educate, well, what do you need to do? And that comes with education from the regulator. It comes with clear guidance of what needs to be done. And it's our virtual asset service provider licenses, but given to retail and given to the brokers in Hong Kong and financial market participants, including JP Morgan, including Goldman Sachs. I think most of the institutions have located their trading desks in the US. They're not in Hong Kong yet because it's not quite kosher yet. You don't have a license to do it yet. So we need to get the licenses out there. If this is what we want to do to be a digital asset economy. And that includes getting ready for CBDC. And you're aware that Hong Kong has signed a MOU and is working with Thailand, Saudi Arabia, and China, as well as Hong Kong, the 4 parties, to get a CBDC out. And China is also doing it. So we have to be ready to take these CBDCs too. So yes, Chiwon, I'm totally in agreement with you. We need to retool, but we also need to have an okay by the regulators and by the government that, hey, I have a blueprint and this is what we're going to do.
Yeah, makes a lot of sense. You can't get through this just given all of what's happening without the regulatory nod. And good luck to the HashKey group and Hong Kong BitX with your current license application process. I do hope that's expedited and we can see some great products come to market. Now, there's obviously more questions I want to ask, but we're mindful of time and we want the audience to participate. So on that note, I'm going to pass it to Kat and Emma, who are the co-chairs of the blockchain committee at the FinTech Association of Hong Kong, to field questions from the audience, because I'm sure many of you will want to ask them their views on specific themes that you want to touch on.
Thank you, Ben. Thank you, Angelina, Jonathan, Yoon, and Henry for all the great, comments. So the first question is going maybe a bit to you and then to all the speakers. So the convergence between crypto and traditional world seems inevitable. Tremendous future potential. Will the traditional venues be able to catch up given legacy infrastructure challenges? Will the newer crypto exchanges be allowed to play in the old boys club? And I would add, what are the barriers to entry, from, all your companies for, more, for the, maybe the large banks will get in the space really soon, when we see HSBC, buying a large stake into Consensus. So, we can start to see it coming, maybe where it can go. So Ben, you can add, a bit of perspective there, and then some of the panelists.
Sure. So I think all these disruptor exchanges have a window at the moment, a window of a few years to really nail it. Because when that dematerialization drive happens and all the incumbents start to move everything on the blockchain on their back end, that's the safety bet. And, it kind of raises the question to me, will the big traditional IPO style deals come to these new disruptor exchanges? Oh, there has to be a certain level of appetite. The underwriters and sponsors have to be all right with it. There's a lot of moving parts that could make that a bit more tricky, but we all know it just takes one big deal. And as soon as that domino effect starts, there's major FOMO. Everyone's going to be looking at this. So I do hope to see those deals come to market. And I think these disruptor exchanges all have the capacity in the next 3-4 years to just crush it. And when all the legacy incumbent exchanges start to move into this area, they're not going to be as innovative. They're going to be behind the curve. That's my view. Right? It just takes that one. And I'm sure the other panelists have plenty of views on this particular topic as well. Yeah.
Maybe I can ask Yoon, since you were talking about, the infrastructure at some point. So, there are some points given the legacy infrastructure challenges. Maybe you can, develop a bit your comments from earlier.
Sure. I think, I agree with Ben's observation that traditional exchanges, once they retool themselves to be able to handle these securities, will have a big advantage because they already have scale, right, to this. But as Ben mentioned, I think there is a window over the next few years where I think crypto exchanges and other digital asset brokers or dealers can actually break into this space and make a lot of headway. I think ultimately our contrasting propositions and licensing statuses will put us on different paths to becoming a security token exchange. So the way in which a traditional exchange becomes a security token exchange will be very different from a crypto exchange becoming a security token exchange. And all of us will have to find our own way to ending up and being able to handle those securities. So, I'd love to hear some of the other comments, but I would just make that observation that the traditional exchanges will have the scale to really make a big imprint once they change and renovate their infrastructure. So we have this window that we have to take advantage of.
We have an interesting point, and Chi-Wan, I totally agree with what you said. We have an interesting thing in Hong Kong. HKAX is a monopoly on the stock exchange side. You have to remember that. So anything listed in Hong Kong actually belongs to the exchange and can only be done. So that monopoly in itself will be an issue. However, if a structure can be found and working with lawyers and if some giant company that's very, very amazing, and Jonathan touched on this, if it's some killer app, killer company that decides to say, you know what, I'm going to eschew using HKEX. I'm going to go for FTAHK, BitX, Fusang, Diginex, all of them. I'm going to do a tokenization through all of them. and all of them can sign up clients, assuming that the SFC is okay with this, then you would make a big enough splash, possibly, to start changing how people think. And it will take something like that to really move the needle, if this is the case. And I think it will have to be our industry working on this together to do this type of thing, and hopefully maybe convincing one of these killer companies. And I'm not agnostic to any company, but if it was something like Ant Financial that listed on a tokenization platform and said, you will do it this way, I require you to do it this way, then you'll get adoption. Just as with dematerialization, the first exchange that the first company that decides to work with HKEX and say, I want this totally dematerialized, I don't want paper script anymore, then the exchange will change. So it has
Sorry, I was gonna say, just to supplement Angelina's point, one of the reasons why HKEX has moved to adopt FINI, which is their version of shortening the settlement cycle, was because Alibaba wanted to come and list, and they took what I had said was the traditional settlement cycle of being, approximately T+8, because sorry, I used to work in IPO at HKEX. This is how I know all of this. So, when Alibaba came in and they were like, we're doing it this way and it needs to settle in this time frame, and this is our secondary listing and it's going to be the first one that comes in from China, and they forced HKEX and they forced the SFC by dint of the fact that it was such a large offering to come in and settle on T+4. So once the SFC and HKEX saw that there was a way to make this possible, this kind of kickstarted the process for them to think about FINI. But even if you look at the consultations for FINI, they're still only coming down to T+3 because the SFC still isn't quite comfortable with instantaneous settlement and removing a lot of the middlemen, which is, kind of the byproduct of anything that comes out of tokenization. Sorry, panelists.
Absolutely. Well, maybe if I can just add to what everyone else has been talking about, and maybe just plant a thought, because I think whenever any new technology comes about, the initial benefit is always quite linear: better, cheaper, quicker, faster. Exactly what we've been talking about today. To me, the more interesting benefit are the secondary non-linear things that, what can you do with this new technology that you just couldn't do before? And I think that the two big things that tokenization is going to drive in capital markets is, number one, we're going to see a lot of disintermediation. So people talk a lot about DeFi, at least when it comes to securities. I think that's going to come a bit later, but disintermediation, going from B to B to B to C, just like how I used to go and have to sell products in Lane Crawford, and now I can sell things on Amazon. The same thing's going to happen in capital markets. Companies are going to say, I want to go B to C, direct to consumer. More and more companies, as you mentioned, big companies, someone like Anne is going to say, wait a minute, right now, I don't even know who the hell my shareholders are if I'm a listed company. I need to pay an expensive IR firm just to try and figure out how to get in touch with them. If I can tokenize all of my shares, stick them on a blockchain, I can just email my shareholders, job done. So that's one big benefit, going B2C. And I think that this is inevitable because this is happening in every industry in the world, not just finance. The more interesting thing, though, is when you look at the ICO market, the one powerful thing I think they showed is that it's possible to build alternate value networks. ICOs are, let's face it, not based on anything, no real fundamentals, shaky at best. But people ascribe value to them because they could construct these alternate value networks and create value almost out of thin air by bringing together these ecosystems. And I think there's absolutely no reason why you can't layer these alternate value networks on top of real securities. There's no reason, once you have a tokenized share, why you can't also give that utility value and use that to power an ecosystem around a company. To me, those are going to be the real drivers of tokenization in the future. And that's why, maybe if I can offer a bold prediction, I actually don't think a lot of traditional institutions will be able to make that jump. I suspect that, to use Chiwon's a metaphor, while they're so busy renovating their houses, everyone's going to have moved on and be living in the metaverse.
Bold
Great.
prediction. Yeah.
Thank you.
Yeah.
if it's okay, we may move to the next question. I have a feeling we could go on infrastructure for a very long time and have a separate webinar on that alone. So I'm going to be a bit cheeky, and I'm actually going to throw this over to my colleague, Jonathan, and I'm going to ask him, because of his insurance background and also because of, his picture in the SCMP last week, to answer Giles' question about insurance. So essentially, we're asking about whether there are any initiatives on cryptocurrency and digital asset insurance that are happening within Asia. There's a reference to the work that was done between Tokyo Marine and MSIG in 2017, but maybe Giles missed the news. Nothing's been happening since 2017, Jonathan, is that right?
Let's be clear, this is not an advertorial.
No, this is not an advertorial. I'm here in my capacity as co-chair.
Thanks, Kat, and thanks for a clarification, Ben. So, yeah, to answer your question, there has been something that happened. Last week, Hong Kong BitX and 1 Degree made the news, if you guys missed it, was that we finally had a breakthrough in Hong Kong where 1 Degree is a virtual insurer here in Hong Kong. They are going to provide $100 million worth of coverage to the Hong Kong BitX and our sister companies. That has taken a long time to get there. It's not easy. Back in 2017, me and my colleagues back in another firm, which I wouldn't name, has already looked into this, but it was not fruitful. A lot of insurers, although they are in the risk business, they are very risk adverse. And when we're talking about, hey, can you, provide crypto insurance? They're like, I'm just getting to learn about cyber insurance. How can I make that leap from cyber to crypto? Like a lot of the people that we spoke to, and that was a lot. We BD'd a lot of insurers and it was not easy. I know this because personally, that's what I've been spending my past year with BitX on, one of the projects that we're doing. And I'm very proud that we did reach this arrangement with 1 Degree, but it takes a lot of passion, not only from two companies, but the people within these two companies to really find that overlap, to find that knowledge between insurance and crypto. I mean, everybody can see that in the infrastructure, this piece is lacking. Asset managers, wealth management, custodians, the whole supply chain is there, but insurance is lacking. I mean, if you were like a licensed fund and you want to invest into cryptos, how can I invest into cryptos when the custodian that holds it doesn't have insurance, right? It's one of the checklists. How do you get through the board? How do you get through governance? And sadly, there's a very lacking risk appetite for this globally. So I guess in the near future, we're still going to be faced with that gap, that protection gap, but it's a required, it's an important infrastructure piece that we need to put together. I think ongoing, we would see more and more insurers because of this. We are, I need to, keep the mystery here, but 1 Degree and us, we are thinking about putting together a think tank, and we would, invite other exchanges and other players to come together and become the voice for the industry and do some lobbying and also set best practices so that more people in the industry and especially insurers and brokers understand the risk involved and they're not scared by hearing the word crypto or digital assets and providing insurance on that.
Thanks, Jonathan. Does any of the other panelists have a view, or shall we move to the next question?
I would just say that the insurance industry would really welcome that too, Jonathan, and we'll get a lot more choice. So please make sure that 1 Degree does talk to the insurance industry too. So that'd be good.
Congrats to Hong Kong BitX on that. I imagine that was a long and painful process, but good on you for getting there. I think we have probably time for one more question, Kat and Emma. Would that be right? Yeah.
Yep. Emma's got the next one.
Yes, sure. So I will rephrase the one a bit from Nicola, because he's asking about the interest from transferring money across borders, but I think it's a bit outside of STO. But I would say, how important are CBDCs or stablecoin in the STO process? in order to fasten the settlement, how important is it to have that in place so that STO can take off? Who want to take this one?
I'll just share an initial view, but I think the whole
sure.
idea why tethered stable coins came about is because the crypto ecosystem really needed some form of stability around value and asset transfer, right, within and across the ecosystem. Their link to fiat provides that, but I think creating the direct representation of it in a digital form will expedite that process even more. So I do think it'll be an important fuel or lubricant to the system in terms of its continued growth, because many of the other digital assets in the universe are just too volatile for that payments and transaction process to take place. That there needs to be some form of currency, and creating a digital form of currencies actually will be a big plus.
Absolutely. I mean, maybe just to add on to that, Ben, that's clearly a massive benefit. I think an equally large benefit of CBDCs will be the simple fact that if a country has put its fiat currency, its literal unit of account, onto some kind of DLT or blockchain-based system, it becomes awfully hard to argue that you shouldn't put all the rest of the assets in the country on some kind of similar system as well. And certainly, I think the large shift towards, I think, like 180 countries in the world now looking at CBDCs is really what's driving a lot of traditional institutions. So they suddenly said, oh my, if governments are so innovative, we better get a move on.
Yeah, I would simply definitely echo those sentiments. By introducing CBDC, I think the government is actually creating the infrastructure necessary to deal with digital assets, right? And to a large extent, they're working on the plumbing and the piping for the whole ecosystem, and that will help legitimize and accelerate adoption of digital assets for sure.
Wonderful. Look, mindful of time, so I think that would probably bring us to the end of this webinar. So look, I mean, just from my perspective, and I'll allow Kat and Emma to close, but personally, a big thank you to Henry, Chi-Won, Angelina, and Jonathan for sharing their time, their expertise, their insights today. It was very straightforward. I love that. It's true to the point. There's a little bit of advertorial stuff that's totally cool, but it's great to see such good participation and such a strong panel of players trying to bring this industry forward. And I do have a very hopeful future of how this is going to evolve. And I'm super excited to see all of your businesses in coming months and years and how it all plays out. Kat and Emma, over to you, but thank you to everyone for joining.
Just to echo Ben's sentiments, this has been a fabulous conversation. You can see from the chat box that everyone was like, we could have gone on for hours. Maybe it is that we do round 2 in 6 months' time as a bit of an update. And if anybody's interested in that, please, of course, reach out to Emma and myself, and we will champion your ideas for future webinars. But thank you to our panelists. Thank you, Ben, for co-hosting. And I wish everyone a happy evening, and I'll see you all soon. Bye.
Thank you all. Last thing is, you'll see in the chat box a link to the report for those of you who want some bedtime reading or something to knock you out to go to sleep. But yeah, have a good evening, everyone. Thank you so much.
Thanks, everyone.
Thank you, everyone.
Thanks, Emma. Huge thank you to both of you.
Thank you. Thank you. Bye.